how does a Canadian retire with $1 million? So I'm going to go through an example today and use a 60-40 portfolio with $200,000 in a tax-free savings account and $800,000 in an RSP. So I gave RetireCan a little bit of a facelift. Basically, there's a little more real estate on the iPad, so I just made the labels a little better for those users and just made it a better full screen experience. Now, before I get started, the major change, when you click this calendar, it's going to convert your monthly recommendations to annual. Use this button every January when you withdraw your money for the year, and halfway through, take a little checkup, and if your investments have done well, take out a little bit more. Basically, it's just spreading out your tax bill to help you pay the least amount of income tax. So I guess another big change, I did change the color scheme a little bit, used Apple's natural colors, and now the apps are available in light and dark mode. So some new features, you can learn about the stock market and do some financial education by clicking the cap. Basically, you can search any term. If you want a term that you think is missing, send me a quick email. You can just click this thing and we'll send you right to your Apple email. The other quick little thing is here are kind of assumptions and guidelines from publications. So the 2025 projection assumption guidelines, this is from Financial Planning Canada. This will kind of help you when you're first building out your portfolio if you don't have any returns, to kind of give you a guideline of what asset class is going to perform what. Essentially, always use your returns, your since inception. If you've been investing for 15 years, use that long-term number. And there's also important information like, the tax-free savings account room each year on there. So basically, again, it's so easy. You're 65, you're retiring at 65, you're going to live till 95, you're getting the average Joe CPP and OAS at $1,534. Going to use the financial planning 2.1 inflation rate, recommendation. You have $200,000 in your tax-free savings account, invested at a 60-40, getting 7%. Show you how easy that is in just a little bit. You have $800,000 in your RSP. And all you're going to do now is click what province you live in. So essentially, I live in Ontario. I'm going to click Ontario. I've got $1 million, and this is going to pay me $5,900 after tax monthly income. So that's your budget. That's the money that should be in your pocket after you pay tax. You're going to withdraw a little over $1,000 out of your tax-free every month, a little over $4,000 in your RSP every month, and you don't have to worry about any taxable accounts. So that's basically how easy it is. Click the calculator and it will convert everything to annual. So you're going to be about at $71,000 after tax that's in your pocket. This is how much you're going to pull out of your tax-free if you do that every January and RSP. It's about as easy as that. This is just a quick estimation with 7% returns. And when you click the chart just down here below in the middle, it's going to show you kind of how your money grows. So with the iPad, I have a little more real estate. I did put the money on the left and right side. And basically, when you touch the button in the middle, it will show you how much money you are at what years. So just drag the bar, and you can kind of see how your income's slowly growing. It's that 2.1% inflation rate that you chose. Now, the real money return, this is the Bank of Canada number, 3.05. I'll update this about once a year, but essentially it was 3.06 and went down to 3.05, so I just changed it because I took a look. And essentially, this is your money dropping down a little bit. And this is what you want. You want to front run your retirement a little bit. You want to spend more money while you're younger. So using Portfolio Visualizer, we can take a look back and just see the performance of a very simple two-fund portfolio. We're going to use a global equity, your iShares MSCI World Index ETF, and a Canadian aggregate bond, the BMO ZAG. I'm just going to go through basically why you want to use asset location, and we'll use the software to kind of show you exactly why you want to do that. So we're going to build a 60-40 portfolio just to show you the performance. We can look back 10 years for free with the software. And basically, we're going to build a 100% stock portfolio. You should probably put just stocks in your tax-free savings account. And with that money left over, you're going to put $400,000 in both XWD and ZAG in your RSP and basically have a lower risk RSP portfolio. So that 60-40 portfolio grew at 7.59%. That's how easy it is. If you can learn how to click buy twice, you can beat the majority of financial advisors out there. Fees are just eating away too much of your returns. So the 100% XWD portfolio grew at 11.45%, and the 50-50 portfolio still grew at 6.6%. So remember those numbers when you use them in the software in just a little bit. So the more accurate information you give RetireCan, the more accurate the projections are going to be. So if you're getting 7.59%, put that in. Like I really stress, you want your returns in there because it's going to allow you to withdraw more money. You know, technically if your money's growing at a better pace, you should be able to withdraw more money. And clicking annually, you can see the after-tax income is now $75,000. If your returns are that 0.59% difference, it's compound interest. Like that is a huge difference. You can pull out a lot more money. So when you use asset location strategy and just put that $200,000 in just XWD and $800,000 you're going to invest half XWD and half ZAG, you're still going to get that 6.6 returns. That's probably beating a financial advisor. And then you're going to click Ontario again. You can see it just squeaks out just a little bit more money. We're going to click annually and see just when your stocks grow in a better tax advantaged account, you squeak out a little bit more money in your retirement, and it just makes your life a little bit easier. Your portfolio is still 60-40. You're just using tax advantaged accounts a little more efficiently by putting your stocks in your tax-free savings accounts. So your after-tax withdrawal rate is going to be better because they're not taxed as you withdraw them. So if your stocks grow only in your tax-free savings account, you're just better off, as you can see. RetireCan, download it.